As many as 8 public sector banks may tap the markets over the next few months. The government, as part of its recapitalization plan, wants these lenders to go raise their own equity capital to supplement the funds that the government is going to provide them. The question is, do these banks have a strong enough story to pitch to investors? Bank of Baroda is among the banks which has board approval for a QIP issue. PS Jayakumar, MD and CEO of Bank of Baroda, joins us now to talk about the pitch he's likely to make to investors. Good morning, Mr. Jayakumar. Thanks so much for joining us. First off, can you share any more information on your plans for a QIP issue? I know you have board approval in place. Anything about timing or the tranches in which you intend to raise money?
Okay, let me put it this way. At this point of time, our primary capital, which is CET1, is still in a very comfortable position. And as such, we are not hard pressed to raise capital at this point of time. And also, even for the growth of our customer assets, we see reasonable room for optimization. What we have done right now is to take an enabling resolution that would empower us to raise capital, raise equity capital at an appropriate time. And then we are also waiting for the plans with respect to the recapitalization and all of that to be announced. So in a summary, we are getting prepared, but we actually have not fully thought through or fully decided upon what that amount is going to be and exactly when we are going to tap it. That really is the position.
Okay. Do you feel, though, Mr. Jayakumar, that you're fundamentally more ready to take your case to equity investors in terms of cleaning up of the book, clarity on where you go from here, the value ascribed to your book, on all those counts? Are you more comfortable?
I think we are reasonably well placed. If you see our quarter, the last quarter results, all the indicators, whether it was asset growth or revenue growth or stability of the NPA or increasing margins or the operating profit, was particularly positive. We hope we can keep the trend, although there are some uncertainties, particularly in the way some of the telecom assets, loans that were given to a couple of telecom companies may eventually play themselves out. But having considered all the things together, I think we are in a good position to both articulate a story and build a case that Bank of Baroda stock would be a growth stock.
Mr. Jayakumar, does the recapitalization plan, it's a large amount, give you comfort that you'd have the money that you need to strengthen your position, your provisioning as well? Also, while we're on the topic, do you have any details of that plan, when the recap money will come in, etc.?
Well, I think the policy is under formulation, and there have been a lot of discussion around it. And I don't have any more information than what is generally available in the public domain, personally speaking. I do think I can make a kind of a good guess around how that whole thing will eventually play out. But I guess the important thing for us, I think, would be to make a solid case as to the need for raising capital with all our equity shareholders, including the government, and be able to demonstrate that is good money that is going to help the bank to grow and help us to provide adequate returns to our shareholders. I think we're reasonably confident about that. We've also been engaged in this massive transformation exercise across various parts of our business to make our processes much better, to have more digital and digitization, the whole theme around people and their management and all of that things together. And those initiatives are going quite nicely along, chugging along quite nicely along. So all things considered, we are moving fairly okay with respect to our trajectory. And I do think we have a very good case overall for the ability to use capital sensibly and to grow our balance sheet and our customer relationships.
Okay. So I'll come to growth in a minute, but I do have a couple of questions on asset quality. I think the next big issue that everybody is watching is what happens to the second list of accounts identified by the RBI. What is your provisioning requirement against those accounts and your exposure, if you could share?
Surely, yes. Without taking into account all that we have done so far, the total coverage ratio with respect to List 1 and List 2 is around 54%. The exposure in List 1 is on, I think, 10 companies with 7,400 crores or thereabout, and in List 2 it's around 4,500 or thereabout. That broadly are the numbers. We currently have a provision of 54%. But it is in certain assets we are fully provided, in some we are provided 60% and above. So if everything is brought back to 50%, in other words, every asset must at the minimum be provided 50%, we have a catch of about 1,000 crores to 1,100 crores of additional provisions to be taken. We're still waiting for the outcome for list 2. There's still some work underway, and we would get to know the full picture by the end of this month. But assuming all the exposures we have would be referred to NCLT, then the incremental provision that we would have to make over the next 2 quarters would be in the 1,100 crore level.
Okay, thanks for that detail, sir. Just the other uncertainty around this whole issue now is that promoters are being kept out of the bidding process. Some are worried that that will mean a lower price discovery for banks and hence higher provisions. What is your view?
Okay, let me put it this way. Our own exposure with respect to most of these assets and the total exposure of those companies on the 1 to 1.5% level. So we're not really actively involved in influencing the outcome other than supporting the consortium bank to go ahead with the plan. Now, there is always arguments and arguments, one side of the argument being that this is necessary to get better pricing, and the other side of the argument is that there is a moral hazard, and a change in this kind of regulation will ensure, even if there are some short-term costs, of better compliances going forward. So both these exist, but whichever side you want to support, or whichever argument you are more favorably inclined to, is not of any relevance now, because the law is what it is. So I think instead of debating whether it's good or bad, we just move forward from here. My own preferences may be on one side, and you may think about it differently. Those are points of views, and both may have a compelling case, but it's a law. And the position is what it is. So I do see, though, that there is a sufficient amount of interest in many of these assets. I can give you some example of that we are for the first time seeing demand for a secondary market purchase of some of the assets which are an NCLT, and the preliminary offers are close to or a little above the provisions we have so far taken. So these kind of movements would not happen unless the assets are going to see, the underlying transaction is going to see value. So based on the limited set of information flow I have, my conclusion is that probably this may not be a large deal, but we have to wait for the whole story to play itself out. There's also a lot of interest from companies which are big. Many of these assets are good, and there is a consolidation opportunity for many of the players in the steel sector and the power sector. So let's watch, but I don't know why we need to take a very particularly pessimistic view.
Okay. So just moving the focus to growth, at a system level, we have seen a small pickup in credit growth. What's happening at your bank? Are you seeing growth returning?
Okay, as we've been talking about it, our growth has been, I guess, on a year-to-year basis, the precise number may be around 13.5%, 13.4%. So for us, at least, the growth is there. In the retail side, our growth has been on 26%, and specific to the home mortgage loan that we are focused on, the growth is around 35%. One of the things that's also happening now is that many of the large companies are beginning to consolidate the relationship with a fewer set of banks, and that by itself will result in us being able to access new clients and expand our relationship with the existing client. So we still stay to our earlier forecast of a end of period growth between 12 to 15% for this financial year. But outside of that, as the industry growth itself is concerned, there's a lot of projects being announced, a lot of efforts, initiatives being launched. And while we may not have a near-term data on it, there's also been some disruptions as we transition from one form of taxation to another form of taxation. And so that immediate growth may not be there. But clearly for the bank, as our bank as an institution, we see growth opportunities very much there on the table, and it's clearly evidenced by the results that we are seeing through this year.
Any specific segments? I'm not going to ask about retail because I think every bank is chasing retail. But beyond that, where do you think you can grow? I heard your team talk about supply chain financing as an area of focus, for instance.
Yes, absolutely. See, there are two things that are happening with our portfolio. One is we're trying to also run off certain types of assets where we do not have a very strong relationship with the client, or that the extent of the relationship is very small in relation to the total pie of the relationship, or where the risk reward equations are not very favorable. So there is a part of the portfolio that is being allowed to liquidate, and that will continue as we optimize the balance sheet. But on the other side, we're trying to have a much broader relationship with our clients, and that would move away from simply looking at term loans to being able to straddle the whole range from from loans to advisory. So we put a lot of effort in developing many programs. Some of this are, as the supply chain was launched last week. I would say it is state of the art. I would say it's better than any comparable platform. And although we are coming late in the order of the day, I think we should be able to get a sizable share. And the way we are viewing all of this is that each one of this is a part of the puzzle that we have to, it's a part of the jigsaw puzzle that we have to fill in, so that what we offer to the customers is a very complete solution. So next on the rollout is our program relating to a more electronic trade management platform. And also on the rollout is a strong cash management program. And we're also strengthening some of the advisory capability, particularly in respect with debt from the BOB capital market unit. So by putting all of these things together and sharply defining the target market and trying to develop the target market in a way that our balance sheet and our exposures get better managed, better diversified, I think all of these things are in play. And so getting all of these new products will certainly gives us a better opportunity better opportunity in a competitive sense. And with respect to supply chain in particular, we're not only looking at the first level of financing from the hub to the spoke, but we're also trying to see how we can work it through multiple levels from there, so that we can finance, so to say, the last end of the supply chain, which might be a mudra type of loan. So as we go through that process, I think our exposure to SME segment and the middle markets would substantially increase, and would increase with quality credit and a capture of the cash flow.
But you're confident about the quality of the credit in that segment, as you were just talking about. You mentioned Mudra, for instance. We hear that there the asset quality trends have been slightly worrying in the early days.
It depends. Yes, you could say that, but it depends how you do any program. For example, a couple of weeks before, we launched a very extensive reach around looking at social inclusion by enabling those customers to replace their petrol or kerosene-driven motor pumps to a solar-based, renewable-based source, which would enable those set of people to have the cost of input considerably reduced because of the change. Now, as we do selected and targeted program that results in benefit the customers, surely the repayment history would hold itself through. So the question now, as is always, is that are we having a clearly defined set of customers we want to work with, and we reaching out to them, or we just waiting for customers to walk in? The first set of customers will always outperform, in a portfolio sense, the second set of customers, and that really is our approach to the whole SME MSME play. So that is there. But as far as the residual portfolios, existing portfolios are concerned, some clearly are at risk as they cope up to manage a more formal taxation system relative to a less formal taxation system. And so there will be some churn happening around it. But overall, I think we should move forward from here. So to sum up, I think in an economy that is likely to grow by 7 to 8%, there is enough opportunity for growth, and there is enough opportunity to be optimistic looking forward.
All right, so just one last question. A few quarters back when we had chatted, you had mentioned that you'd started the transition towards IFRS, or at least started doing the numbers. Do you have a clearer idea what this will mean in terms of additional capital that you may need?
Yes, it's a complex set of items we need to discuss. Obviously, there are some benefits we get from revaluation of certain types of assets, but those revaluation could be ephemeral in nature as interest rates move. So the real issue comes back again to the same point: the extent of provision you need to take on the standard asset, and the extent of provision you need to take by way of loan loss reserves. So the lower the amount of accounts we have in the SMA 102, and the lower the amount of assets we have on the restructured category, and the better is the quality of the new origination in terms of the rating, lesser would be the requirement for additional capital with respect to IFRS. So that whole thing is being worked out. I don't have a full number on the table as yet, but getting that in place and knowing what the rules are going to be also simultaneously, how they're going to fold out, would also be important as we think about a capital raising plan.
All right, Mr. Jayakumar, thank you so much for that conversation, 360-degree conversation on asset quality, growth, and some of the accounting issues in play for banks.